In this video, I'm going to teach you about asset classes and the role that they play in your investment portfolio. Hi, this is Yolanda and welcome to the Financially Fabulous Females YouTube channel. In this channel, we give you easy, actionable tips, content and strategies that you can use to manage your money well and to build generational wealth. If you're new here, please hit the like button. Also subscribe to this channel. So every time there's a new video out, which is usually on a Thursday evening, you're going to be the first to know about it. Hit the bell notification as well, so you will always be notified of any live videos, new videos that we come up with. You'll be the first to know. So today we're talking about asset classes and the role that they play in your investment portfolio. And this basically applies to everything from your bank investments to your pension and your provident. So it's very important for you to understand what this is, because this is the foundational element of your investment portfolio. And no matter what you're investing in, you got to have an idea of the various asset classes, mainly because each asset class is linked to a level of risk. And if you're matched incorrectly in terms of risk and your exact risk appetite, it can be disastrous. So what is an asset class? Basically, it's a collection of investments that behave the same, that react the same to a market. Traditionally, asset classes are broken up into four segments. Firstly, there's government bonds. And government bonds are basically lending instruments that the government issues to raise funds. Then there's equities, and those are shareholdings in companies. Then there's cash in the form of foreign currency or even the money market. And then there's property in listed property, shares and REITs and that kind of thing. And if you want to know more about property investments in South Africa, click the playlist here and it will take you to an entire series that we did on the property investment sector in South Africa. So let's break down each of these asset classes one by one. Firstly, equities. Equity is basic share ownership in a company. And in South Africa, you have an opportunity to buy into all of the JSE listed companies via a stockbroking company. And as an owner of the company, you own a share of the company. You have a right to shares in any profits that the company is distributing for that period. And these profits are usually paid in the form of dividends. And obviously, in South Africa, dividends are taxed as well. So dividend amounts varies among companies. The boards sit and they will look at the profitability of the company. They will allocate those funds accordingly, more funds into research and development, marketing, etc. Bonuses, of course. And then whatever's left, the board will decide on what gets distributed to the shareholders. So each time it's different. Sometimes it could be more, sometimes it could be less. And sometimes when companies are paying a very high dividend, it doesn't really mean that the company is doing well. There could be lots of reasons for actually high dividends. So you got to do your research and try and understand exactly what's going on with the dividend payments. Then we have the debt instrument of government bonds. So government bonds is a basic way for government to generate more income. For example, in South Africa, the tax revenue is not enough to spend on infrastructure development, social projects, and building up the economy. So the government has to raise funds in another way, and they issue government bonds, which is basically an IOU, where the government says, okay, give us 10 million rand, and after 20 years, we'll give you your 20 million rand back. And every year we'll pay you 10% interest. So how it works is when these ratings agencies downgrade South Africa, it basically tells investors that South Africa is not a good environment to invest. So all of the investors from around the world via their stockbrokers, via their companies and asset management companies, those asset managers won't buy shares in South African companies or buy South African bonds. They're very reluctant to do so. So government has to entice them a little bit more by offering them a higher interest rate. And that is why there's a big hoorah every time South Africa is downgraded, because the cost of borrowing for the country goes high. And if we look at the debt to income ratio of the country, it's out of control. And this is the situation the country is in, where the cost of borrowing for the South African government is very, very high because of the environment, political, economic, and social environment that we're in, largely due to the policies and the corruption. So it's a chain reaction. When you hear these big headlines in the news, don't look at it in that one segment. it has a collective impact on every single one of us in the country. Then we have investments into cash holdings. Then this can be foreign cash, dollars, pounds, euro. Just like how you would buy dollars when the rand is strong and hope for the rand to fall and then sell those dollars, and the difference is the profit. It's the same in an investment portfolio where the asset managers basically hold foreign cash as a hedge on the rand. And also in the form of money markets, where you park your money in a money market. A money market is traditionally a parking bay where you hold it temporarily while you decide on the best investment options and what you should do with your money. And to put your money into a money market account or a money market investment, the bank will pay you low amounts of interest. Interest is guaranteed, and that is why the interest is really low, especially now with the repo rates being so low. And finally, we have the property segment. We did a whole segment up here on property and how it basically works. Typically, you buy shares into construction companies or REITs, and you get money back in the form of rentals or dividends from those companies. So those are the 4 traditional asset classes in South Africa. So me as a financial advisor, I would sit with you if you want an investment portfolio, and I will use a combination of those 4 asset classes to develop your investment portfolio. But that is just one half of it. The second half is try to understand what your risk level is. What type of risk can you stomach? Are you okay to stomach the ups and downs of the equity market? Or you want something simple and traditional going on that upward trajectory? So for me to do that, I got to understand your risk appetite. And I do that by doing a risk analysis. So if you want a professional risk analysis done, click the link below and I will set up a one-on-one appointment with you to try and give you an idea of what risk level you're at, whether you're aggressive, moderate, or conservative. And I'll give you an idea on the type of things that you should invest in based on your risk appetite. So as an advisor, I would combine these two, your risk appetite or your risk profile, and I will use a blend of these 4 asset classes to try to come up with a recommended investment portfolio for you. Obviously, if you are a more aggressive investor, I would give you more shares, more equity holdings. But let's take a deep dive and try to understand the role of risk and volatility as it applies to the 4 asset classes. So this is a risk and reward matrix that I've developed just to show you how the various asset classes and how they're rated for risk. On top, we have equities, and as we've discussed, equities is a very high risk asset class. With that being said, because the risk is high, the possibility of reward is also high here. And we also experience high levels of volatility, a lot of ups and downs in an equity investment. Then we have property, medium risk, medium reward, and medium volatility as well. And the bottom 2 asset classes, both are low risk, low reward, low volatility. Both give you consistent low returns with a very minimum risk. So those are the 4 traditional asset classes. And if you're a keen investor, you know this is not the only thing that's around. There's also CFDs, there's commodities, there's crypto, and crypto is proving to be an even bigger asset class than one would traditionally know about, especially in South Africa, where it's not really recognized from the traditional financial institutions. So let's look at that grid again and try and insert some of these more extreme investment avenues and try to understand where they fit in terms of risk and volatility. So this is an expanded risk matrix. I did insert some of the other asset classes or so-called asset classes that are not really officially asset classes yet. And you can see crypto is right up there. Extremely risky, however, extremely high reward, and with the high reward, the possibility of very high loss as well, and extremely volatile. If you see a crypto tracker and with the graph, and you can see within minutes, not or even seconds, how crypto can rise and fall in a matter of seconds. And then we have other options here, such as futures, CFDs, and commodities. And even if you're trading commodities on the CFDs, those platforms actually give you leveraging. So if you put in $1,000, maybe you can leverage by 10 and you get $10,000. So those as well, very high risk. Because of that leveraging, you can even lose money that you don't even have. So, and again, very volatile on these two markets. And then it goes with the regular four traditional asset classes here. That's where we play in as just regular investors. I mean, if you know these two, and if you learn it and you master it and you're doing well with it, great. But if it's something new for you, I would recommend that you learn this platform in and out before you venture into those very high and extremely high investment portfolios. So, the reason why you want to have a blend of these and not just focus on one sole asset class is because if that one asset class crashes, your entire portfolio crashes. You want to have a nice blend of these asset classes that's based on your risk profile. And by having a nice spread of the asset classes, that brings about diversity as well. So when one sector is not performing, you do have another sector to hold up your portfolio as such. So if you want to find out which blend of asset classes was more suited towards your risk appetite, click the link down below. I'd love to sit with you one-on-one. And traditionally, the younger you are, the more exposure you would want to get to the equity markets because you have time in the market to stomach the volatility that that asset class does bring. And as you approach a retirement, you would want to move away from the traditional equity markets. You would want something more stable, more reliable in your portfolio, especially during your retirement days. So if you're there thinking to yourself that you need to relook your portfolio, you need to match up your portfolio with your level of risk, I would love to help you out. So click the link down below and book a one-on-one with me and we can chat further. Remember, this is just part one. We've got two more in this series to try and give you a better understanding of asset classes and how it applies to you as a financially fabulous investor.